Welcome to Turtle Talk. Dive into the fascinating world of timeless trend-following strategies and the pursuit of the elusive outliers made legendary by the turtle traders. Join your hosts, Adam and Rich, alongside our esteemed co-host, Jerry Parker, as we uncover the powerful principles of classic trend following. From counterintuitive practices to the mechanics behind capturing market outliers, each episode offers a masterclass in navigating the financial markets. Expect in-depth discussions, expert insights, and actionable advice to help you master the art and science of diversified, systematic trend following, turtle style. Tune in every month as we explore the dynamic and ever-evolving world of trend following, equipping traders and enthusiasts with the tools to succeed. And now, without further ado, let's hand it over to your hosts, Adam, Rich, and Jerry.
So welcome everybody to episode 2 of Turtle Talk. Today it's Tuesday the 29th of April. So I'm Rich Brennan and I'm joined here by my fellow Aussie Turtle Adam Havriliv, and of course we have our regular exemplary co-host Jerry Parker, and today we've got a very special guest this month, Salem Abraham. So we created this podcast to have real, honest conversations about trend following, its principles, its evolution, and why the classic trend following approach remains so powerful through all kinds of different markets. So today we've got a packed episode. We'll be breaking down the latest trend following index performance, highlighting how some standout managers in the industry are performing in March, and putting Salem Abraham under the spotlight. We'll also be busting a few trend following myths, and we'll be answering great listener questions from around the world. So, but before we dive in, let's check in with everyone. So, Jerry, great to have you here again. How's everything going on your side?
Everything's great, Rich. I'm in New York City. It is Monday here. So, good start to the week. Good to see you guys. Always good to be with you. And it's nice to catch up with Salem again.
Yeah. So, Salem, fantastic to have you join us today. Thank you very much for offering to come onto the podcast, and a warm welcome to you.
Thank you, Rich. It's good to be here with you and Adam, and it's great to see Jerry, who's been not only a friend for almost 4 decades, but a mentor of mine, and really was the instrumental person that helped me get into this business and find trend following. So I've always, Jerry's always, he's on my lifetime steak list. I send him steaks every holiday season, and there's a short list. It's less than 5 people, but he's at the top.
So just so everyone's aware, Salem hails from Texas, of course, from the city called Canadian,
Texas. It's 2,500 people. We've got 2 stoplights. So
gotcha.
Yeah,
and so Jerry's up in New York, but he hails from Florida. And Adam, how's everything in Sydney?
Sydney, a warm autumn, so very happy with the Easter break, and enjoying April. I don't know if that's the right word for it, but certainly a lot going on this month in markets.
Yeah, definitely. All right, so let's get into it. So first up, it's a battle of the trend following indexes, where we take a look at how the major trend following benchmarks performed in March 2025. So, Adam, over to you to lead us into it.
Sure. Okay. So generally down for the month of March, and with one notable exception that we'll get to. But down for the month of March, and down for the quarter year to date. So. Small losses, I guess, relative to what could go wrong or could be down in markets. But interesting here, I'm looking at the BTOP 50, which has posted a positive month for March and a positive quarter, and then I'm looking at the other indices, including Classic Trend and SGCTA and TTU, Trend Following Index, which are all down. And I'm wondering, why is BTOP 50 up and the rest of the industry is down? I don't know if anyone
I'd
has
say
a
it's
view.
because B Top 50 is not purely representative of trend following. I'd say trend following's been hit probably hard this quarter, but B Top 50 has a lot of other multi-strat in that index, and I'd assume that it's because they're not 100% trend following. Most of the other indexes are, and we can see that they're strongly positively correlated down for the quarter. So I'd assume it might be something like that. Has anyone got any other ideas?
I think you're right, Rich. Yeah, they do other things and more multi-strat.
So it does appear that they are zagging whilst we are zigging, or the other way around. A modest quarter thus far, and then obviously we've got April numbers ahead of us in terms of reporting, and then quite a lot of volatility in this space. And I think we'll get to that in the gossip column at the end of the closer to the end of the podcast. But we've had some really, really big moves in markets, and hence trend following systems with some notable down months or down performance for some large and smaller managers. So let me hand it over to you, Rich.
Let's refer to that VAMI chart of Battle of the Trend Indexes. One thing I clearly see is that classic trend has definitely diverged away from the rest of the trend following indexes. So, they often talk about dispersion within the trend following indexes themselves, but I tend not to see that level of dispersion when I'm looking at these charts. I see that all of the trend following indexes are pretty highly correlated and there's very little dispersion in them. But when we start getting a methodology such as classic trend index, it appears to be distinctive from the rest of the trend following styles and what's been classified in those indexes, we do get that divergence away. So that to me is indicative of a style that is not as correlated as the rest of the broader indexes are. And that's where I think that this classic style of trend following, small bets, massive diversification, let profits run, I think that is what's giving this divergent trajectory. So inevitably, one of the things I do see in industry generally as a broad comment is that I think a lot of the trend followers who classify themselves as trend followers now are probably more aligned with multi-strat as opposed to trend, and they've lost what I think is their positive convexity, their lifting power. And that's because they tend to have adopted a taming of the volatility to smooth out returns, and that has sacrificed the upside performance of trend to a degree. So that's why when I'm comparing classic trend against these other indexes, I can clearly see this marked divergence and this significant lifting power. It doesn't necessarily mean we're less volatile than the rest. It just means that we've still got our lifting power in place, and that's because we let the profits run and we don't, for instance, start selling into trend to reduce our volatility. We go for the fences when we have a trend, and we concentrate into that trend, and that's what I think is giving that divergence. Do anyone have any comments here?
Well, just looking here at obviously the alpha from the classic trend index, blend is material over that 5-6 year period. And notwithstanding, down month to down quarter, that outperformance remains, and you can see that divergence in performance. So, I would agree with you wholeheartedly, Richard.
And Jerry, how about you?
Right, I think it's to be expected. Even the best ideas are going to have periods where they're going to underperform. I think it's a requirement or a requisite for great traders and great systems to underperform at some periods of time. And so short-term performance doesn't mean a great deal. We need to remember that, whether it's absolute or relative. And looking at as much data as possible is always better. And no one has done anything wrong. When you have drawdowns, I have a tendency to take them personally, but no one's to be blamed and no one has done anything wrong. And I think one of the best ideas about systematic trading is to grade yourself on how well you followed the system. And so short-term performance can be misleading, but it does hurt. And we always want to win. I want to win every game, every inning, every period, but it's just not realistic.
Salem, you've been no stranger to drawdowns. What are your thoughts?
Yeah, no, I think if you're doing trend following, you gotta bring a case of ketchup. What do you call it in Australia? It's tomato sauce. Is that what it is?
Tomato sauce.
Tomato sauce.
You say tomato, I say tomato.
Okay, so tomato sauce and ketchup and a big jug of water, because they serve us crap sandwiches every now and then. You got to say, okay, just eat it up. And, but you know why? You got to say, hey, we're 1 month closer to that big month that we're like, this is why we do this. This is why we love trend following. But it isn't this month. It's in the future. But we're 1 month closer. See, so even these bad months, you say we're 1 month closer.
That's making me feel a lot better, Salem. Thank you.
So yeah.
What is moving markets? We've had a correction in equity markets as a result of some tariff policies and some uncertainties about the economic situation in the United States. We've had a big reversal in the long US dollar trade. I think the euro had one of the biggest one-day moves this month in 15 years. I know we have been short the euro over the last 6, 12, 18 months, and I think there's been some pain in both currency markets, equity markets, and commodity markets. I think a lot of things were sold. This month, and I don't know, Jerry. How are markets treating you? What's moving your portfolio around?
Well, I mean, obviously, we've sort of been in a choppy period for a few years in the currencies and the interest rates. So they have not helped, and they have actually hurt and been whipsawed around quite a bit. Now, obviously, we've had a few major trends in 50 to 60 commodities that you could possibly trade. We've had a handful of decent moves in coffee, gold, cocoa. Those are the bigger ones, I guess. But everything else has been subdued and shorts. I think anytime a trader talks about their shorts, they're not doing very well. You can have them across the board, nice short trades, but they're just not going to move the dial very much unless you get the big trends on the upside. So it's just been a period where not a lot has moved. Stocks have done good, decent. It's been some good moves in the stock market, but we just haven't had enough of the big trends. But for us, we had a great 20, 21, and 22. I'd say those 3 years were the best I've ever seen for me personally. I made more money in other years when my leverage was way too high. But as far as just making money so consistently, those 3 years were great. We never had much of a drawdown from that great period. So unfortunately, years later, we start seeing this drawdown and this sort of choppy and sideways, which we were pissed off about. But that's another lesson. Don't get too pissed off about about losing money or losing a little bit of money and not making very much money, because you might get really hurt. And we did, So all of the major moves that you've mentioned, and rally in the bond markets and the rally in the currencies and this big stock sell-off was too much for the trend followers to handle. And we just were positioned in the wrong, incorrectly in all of those.
It's been really interesting to see gold doing really, really well and all-time highs. And you would think that in that environment, there'd be trends all over the place that would be favorable. But actually outside of gold, it's been, as you say, Jerry, a really choppy market. And I don't know, I can't really recall an environment like that where you're getting trends in, what people would argue is a pretty important asset, being gold, but yet everything else is not working for trend followers.
If we look at the last 20, 30 years, it was tied to a regime. It was tied to a growing GDP. It was tied to a more sort of centralized economies, globalization, all of these things. So we're now in a new regime, which is totally different to what we've experienced in the past. So anyone who's been relying on back tests to optimize their models or to determine the degree of diversification they need is necessarily going to have, to a degree, overfit to that prior regime. We're now in a new regime where we've found that under this new regime, we're getting massive whipsaws. There is not the emergence of trends across numerous asset classes, maybe just gold, which is symptomatic of significant uncertainty in the markets. So from my perspective, I think that trend followers have been particularly suffering in this quarter because we're in a regime where there's been no clear direction, no trends. There's been whipsaws from, announcements being made, then redacted, and there's so much uncertainty. And I don't think our models have ever experienced this before, this particular quarter. But what we will find, especially those models which I regard as loose pants models, those that haven't been over-optimized to past conditions, they will start adapting when we do find a direction unfold. And I think that we're still in this zone of uncertainty, a battle going on in uncertainty. Those who want to retain the old order, those who recognize we necessarily need to move into a new order. There's this battle going on, and we're seeing this battle not just in the countries like the US and Brexit and Europe, all of these things. We're seeing this manifested in the markets themselves, this battle going on, this bipolarization that exists. When there is a trend or a direction settled after this whipsawing environment, we probably might get some exemplar trends, but we've yet to experience them. And I think this is going to test models that have been particularly overfit for the past.
Yeah, Rich, I just want to chime in and say that, I agree 100%. You think of trend following, it's not a first responder type system. It's a follower. So I think once, and in times of market dislocation, whether it's, financial calamity, wars, droughts, there's things that have happened, when I look back over the last 40 years, and you'd say, the real big winning years were years that were somewhat chaotic and uncertain. And so we're just starting down that path. And it seems like, you don't want to be wishing for a huge meltdown, but whatever's coming, it seems like it'll be volatile. And I think you're right where we've had some head fakes but I think eventually there'll be a path that the markets start moving down, and that's where trend followers can make money. And so this is the type of market. It's been hard right now, but these crazy environments, crazy markets, I think trend following really shines in it. Not only just with risk management, the tools that trend following give us. I think there'll be opportunities.
So Salem and Jerry, you've been in markets a little longer, than me certainly, and Rich. And how does 2025 compare? The volatility of 2025 so far, how does it compare to your market experience?
Well, I don't think it's unprecedented by any means. I've seen some numbers recently. We did some research. We saw some numbers recently that it was 2010, 2008 to make this look like a walk in the park. So, and it doesn't matter what the past looks like because it can, even if the past didn't look worse, this should not be a surprise. And I don't think your back testing and your research and the systems that come out of that should be optimized for anything in the past. That if you're going to have something way worse than we've ever seen before, these systems may not perform as well. That doesn't sound like anything I've been a part of before. So it could get a lot worse, and we have the tools. You should have the tools to withstand it and to preserve your capital. And trading smaller and reducing your position size is always a good idea if you're getting into some of those bad drawdown periods. And so it just depends upon if you have that in your arsenal.
I agree with Jerry.
Business as usual at Chesapeake. How about you? Salem? What are you thinking?
I agree with Jerry 100%. There's been way worse markets than this. So, I mean, October 87 was so scary to me when you're down 23% on I was 27% in 2 days in the stock market. That was scary. And there's some other times. So this is, yeah. And after you've seen it enough, you're going to put your position sizes are going to go down. So, whatever it is, it should feel the same if if it's 5 times or more volatile, you're trading a fifth of the position. So that's the beauty of I think one of the most intelligent things that's in trend following and in futures trading, you adjust your position size versus stocks where you're all in. And if it's 5 times, hang on, buckle up. But we just dial down our positions, and it takes us a minute to get those positions sized right as you roll along. But I think it's fine. We'll get through it.
All right, well, let's move on to some charts for the month. So, Adam, I believe you've bought a few charts in, and Jerry, can you step through the charts you've bought in?
Well, we've talked about gold, so briefly, I think all-time highs. You can see there it's up 30% or something over 12 months. So that's just been a monster move. We have made a ton of money in that market. I think all the trend followers would have made money in that market. And we are moving our stops up, and loose pants. We're all presumably still long gold, even with that correction mid-month where we dip back to 3,000.
Well, hold on. Some might be selling into that gold rally.
Oh, dear. Oh, dear.
Of course. That's dynamic position sizing.
No.
Oh, right.
That's a sin.
It is insanity. It is insanity. But, I'd contrast that market with crude. Crude has been going down, and so I guess that reflects lower demand for that commodity. And then, pretty much the ultimate whipsaw, at least for us, was in the copper market. And we've seen on the futures at least, a 52-week high and then a 52-week low, I think all within the space of about a couple of weeks. So, and then now a massive rally, of course, to catch the shorts out. So, if you're trading copper on these breakout models, you're not unless it's on a very, very short breakout.
I think Jerry's got something to say about copper coming up.
Sorry, have I stolen your chart again, Jerry?
Well, I'm sure you have a different, an additional opinion on copper. So I think copper is an interesting market. It's really difficult for me to look at copper or think about copper. And my other market is silver, without kind of mixing in March and April. But I think copper is a good chart. It's got some learning. You can learn a lot from looking at that copper chart. One is the benefit of loose pants. Not only does loose pants and having your trailing stop materially away from the price, the all-time high of in an uptrend, is beneficial to capture the big trends, but it's also great to simply not get whipsawed. And so copper has been chopper. I think that's what we used to call it in the internal room, chopper. It has been very choppy. And look, what's the worst case scenario is that it didn't go anywhere very much. It went, as Rich said, it made new highs and then it made new lows and in a short period of time. But at least if you had a trailing stop that was I think optimal given historic back testing, and you wouldn't get chopped up in that market. And I think that's something that's good to remember. And another thing too is you get to hold that original entry price, holding that initial entry price and that initial size based upon the ATR. Now the ATR is so large that the next trades that you put on, if you got out of your copper, you've got to trade it a lot smaller. And copper was one that I did not get chopped up in, but I did get bounced out in April by just a little bit. I mean, so that's kind of a bummer And I think another lesson of copper is the benefit of trading all of the LME markets, all of the base metals. Yes, they are somewhat correlated sometimes or most of the time. Yes, some traders say, well, you can just trade the copper and you'll get what you're going to get out of the LME and the base metals. Not so fast, because copper was by far the best performer, and it still is stronger than all the other LME markets. And so it's really beneficial to use that lesson and to trade all of those LME markets and not just try to replicate what's happening in base metals with copper. And in silver, looks very similar chart, kind of choppy. The opposite, because gold is much stronger, and we could get tempted to say, how do I only trade gold in these situations and not be bothered with silver? But I do think nothing's out there that could say that silver could eventually take over and start having a big trend that could outpace gold. And silver was the other market that I almost got knocked out of, but I didn't get knocked out of. So I still hold that position with this original entry price and the original size with the original ATR. And so now it's still a pretty decent position for us. So it was a monstrous sell-off. And I think in some of these markets, they sell off like this. And when you go through these bad periods, you're just like, what the heck is happening with these markets with cattle and silver? It has nothing to do with tariffs. But then if you can just hold on and follow your system, and when things kind of settle down, you'll be so happy that these positions that you have, they didn't get thrown away. So many great positions. We had to get out of them. The system dictated it. And people were throwing their positions away due to volatility and risk reduction and margin calls. And I think at the end of the day, we should kind of be thankful that we were able to hold on to a lot of these positions and not have to change directions, because in some of these markets, the trends will continue. And but we see this a lot in panic, where all the longs just get obliterated and you may get knocked out of a lot of them. But it's pretty cool when you don't, and you can hang in there, and because things will calm down eventually.
It's interesting, Jerry. When I look at those charts there, I say to myself, a lot of people that are sort of coming into this field of trend following, they've got their little sort of their Dow definition of what a trend is, this specific, must have these consecutive highs. But when you look at the charts that you're presenting here, copper and silver, we can see how messy they are, but we can see there's this underlying directional bias. So that's a critical feature of these trends, this underlying bias, even though the trends themselves are messy. But this therefore demands this sort of loose pants methodology to be able to ride that bias without being whipsawed out all the time, to give this freedom to move. Because, if you start being too prescriptive in your definitions of what a trend is, you'll never be riding these for a start, because that'd be considered too messy or not definitive as a trend. And that's why you've got to relax your definition and start looking at, how do I capture these directional moves that are not necessarily playing out according to a script of what a perfect trend's going to be, but there is directional bias in there.
I couldn't have said it better. I mean, I think to a large degree, this is going to sound strange coming from me especially, but I think we need to not talk so much or not prescribe to ourselves to be trend followers, but to be kind of more systematic traders who go with the data and go with what works in the markets. And this type of strategy that we have, the long-term trend following, the charts will look very messy. And yes, it's trend following, but sometimes it doesn't look like we're in gear with the trend. But the computer and the back test says, hey, these are the optimal parameters in the holding periods. And call it whatever you want to call it. Just do the trades, and this will be the best thing for you in the future, just to follow the system and do the trades and not be so obsessed with the verbal description we give to ourselves and our systems.
Salem, any points to raise here?
No, I think one of the things, the markets that was interesting to me, the euro, so when you've got the dollar getting weaker, and the euro going up, gold going. I'd say I view gold as a currency to a large extent too. You see how weak crude oil is. So with a weaker, here, even if you'd have priced, let's say if you price oil in gold, it's going to look worse, more bearish, or euros, it will look more bearish. So I just, that's interesting. With treasuries, like the 10-year treasuries, in more April here lately after April 2nd, this flight to quality when you're running from stocks used to be you'd run to treasuries, but they're running to gold. And so you saw gold sell off initially for a couple of days, but then you see it start rising. And so I think that's fascinating that the treasuries are not the place people are running to. They're running to gold, and they're running to the euro and running to Swiss franc. And so there's a different safe haven this time, which makes this kind of messy market, the turmoil in the market interesting because it's a little different. And that's fun. So, if you're going to get beat up in a different way is interesting.
Yeah.
There's opportunity amidst the chaos, so it's okay.
And trend following knows exactly how to handle this thing that's counterintuitive. It just stays with the gold trend.
Yeah.
And just to maybe freak you out a little bit more, I think that maybe people are flocking to Bitcoin a bit because it too has held up. There had been a lot of postings on Twitter over the past few months, 6 months, 9 months, about how the correlation between the S&P and Bitcoin was too high, and stocks were up, Bitcoin was up, stocks down, Bitcoin's down. And then all of a sudden things can change. The quiet markets can kind of change. Gold had its sell off, but then it resumed, and Bitcoin was relatively quiet, but a little weak, and it got strong again. So that's the great thing about trend following. We've never seen it before. Well, we have a method that fits perfectly with things you've never seen before. As long as you didn't build this model and these parameters and rules on what you had seen in the past, other than the fact of what parameters and rules work the best to capture the long-term trends.
Yeah,
that's a great point. Yeah, I mean, trend follower will show you the way. The markets will show you the way. You just follow, what's happening, and
All right, gentlemen. Now, look, we were going to go into rising stars and trend titans, but I think what we've covered so far basically covers that segment. So we're going to go straight on because now it's time to dive deep into Mr. Salem Abraham. And so, Jerry, over to you to start drilling into Salem and find out about his trend following history.
Oh, well, Salem, it's great to have you here. Salem has a big reputation and a good reputation, and he's been a great trend follower for many years. And we became friends in the mid-'80s, I guess. And we've known each other for a long time. We spent time together. I know his family, and he's a great family man with eight children who are grown. Now, I think it's 8.
Yeah,
so I think I'm right about that. Yep.
Not much to do out here in the country, Jerry. We had to make your own entertainment, but it seemed cheap. But till college came along, then.
Yeah. Salem and I worked together. We did research together back in those mid '80s, and the trade station. We were using TradeStation, and Salem was helping me. He's a math guy and really good with math, and he was helping me with, I was an accounting major, so I had some learning to do on that. But it actually started out as System Writer. System Writer was the first version, I believe. I don't know if you had that first version, Salem, but then we got into TradeStation and doing some research together. And Salem has invited me, as he said, to his house and took me hunting once and shot all the birds because I was too slow pulling the trigger. But we've had some good times and good stories. But one of the things that I think about Salem is he was very successful. He was a great businessman. He had so many things other than being a CPA and being in investments. But I mean, just over the years, in talking to him and suffering with the markets in a certain periods like we're in now, I just thought, I didn't know anybody better than Salem at just not letting the bad periods bother him. I mean, and maybe they bothered him. I mean, you could be bothered, but one of the golden turtle rules, I mean, the only time I ever saw Rich get kind of mad was when people tried to make excuses for not following the systems because things were not going well. And I think Salem was great at that, especially compared to me at different times where he was so good at sticking with the rules and following the rules. And I mean, I know he had good rules too. I'm sure he had fantastic research and had a great staff. But, Salem, now that you're sort of out of those, being a pure CTA, looking back, what advice do you give people like Rich and me and Adam and CTAs in general that you sort of moved on to sort of a multi-strat approach with stocks, bonds, and CTAs in your current fund? What did you learn when you stopped being a CTA?
Well, first, it's great to be here with you, Jerry, and you're the master. So I am the pupil. I'm the student. I've always still been and now, and I'm always I'm appreciative of Jerry for helping show me the way. I'm a slow reader, a poor speller. I don't do anything very well but math. I'm really good at math, and so when I met Jerry, he said, "Oh no, I do this trading and it's math based." And, it's basically, he's telling me as a math geek, it's like, well, I play this math game and they pay me money to play a math game. And I'm like, that's what I need to do because I love math and it's the only thing I'm good at. I'm not good at anything else. So I appreciate Jerry being generous with his time and knowledge and pointing me in the right direction. And so thank you, Jerry. And it's always great to hang out with you. And it is puzzling, and I think you would have to think this too when you look at all the turtles and who was able to transition from y'all's experience with Rich and Bill Eckhart and then out on your own and run a business. And I came from a background of entrepreneurs in my family, and so running a business was something that I guess I had thought about a lot. And I saw you run a business, and I think that was the differentiating factor in who could really run a business and operate and have employees and deal with all the things. There's just a lot of other things other than just trading. So I think you're the most successful turtle out of everybody, and that's always been interesting to me. And the fact you taught me is interesting. And anyhow, so all that's fun, and it was fun when we did research together because we could learn from each other, and I was lucky. Yeah, Jerry knew way more than me, but I could program the computers and run it, and you need that too. You get older, and you're like, hey, who can do the technology and manage that? So I was lucky to get to be that with you and get to kind of have that journey of research, which is always fun. So now, what I did for 31 and a half years, we traded as a CTA. And in 2019, we stopped trading our hedge fund. We gave back a couple $100 million, a little over $206 million to our clients. And what we had decided in 2018, we started this product called the Abraham Fortress Fund. And what it is, it's kind of like a baseball player saying, hey, I'm going to step away from baseball, but I want to manage a baseball team. And so in it has instead of like 70% stocks, 30% fixed income, it has 50% stocks. Typically, there's a range, but typically around 50% exposure to equities, 20% exposure to fixed income. And then 30% is this, what we call diversifying strategies, which inside of that today is 8 hedge funds. All of them would be, qualify as CTAs, and which is nice. You need that because it's liquid. And then, but then we do a little bit of trading on our own and usually have 1 to 4 or 5 trades on ourselves that help us diversify. And so of the 8 traders that we have today, 4 of them are trend followers. And then 4 do some other things. 2 of them are shorter term traders. 2 of them do one's a currency trader focused and one does spread trading. And so the goal of this was build a product that was what, Jerry, you and I, when I was doing our hedge fund, we would try to explain to people, hey, you should add us to your portfolio. We bring this great diversification. We're not correlated to your returns. That adds a lot of value. You try to explain the math to them. And I liken it to like selling cocoa to a chocolate cake company. And you say, look, if you try my cocoa, it'll work. Everything works better in your cakes. And then you see them mess it up. So what the Fortress Fund is for us is get out of the way. Let me show you how to do it. And so it's an interesting transition at this point in my life too, at 59 years old and now I'm in my mid 50s. And it's like, instead of a, round the clock trading desk, this is interesting to me. And I think we can bring more value to the space just because we can show people how to do something that truly you just can't explain it. You have to understand the math of it. And you have to just say, let me show you what happens if you follow the math. And so really it's the next step beyond, like, why do we do trend following? And then you say, well, you do trend following because it's going to be different than your stock portfolio. But what we're trying to do is build something for the masses that everybody can access through a mutual fund. We call it the Abraham Fortress Fund because what we're trying to do is protect capital more. So we want to give people the kiddie coaster ride instead of the loop-de-loop roller coaster ride. And if we can get it, to the same point, we're happy to get them to, if we can get them to the same point as 70-30, but do it without scaring them and them throwing up and getting nervous, then that's a win. So what I'm trying to do by going this next step is a couple things. First, it's the biggest part is I can be more diversified. Like, I can be the best trend follower I can be, but you see other people with smart ideas too, and other people doing interesting things, and even short-term trading that you say, this seems to be persistent. They found some mathematical, quantitative way to repeat this. And I can't do that, and I'm not good at that, but I can build that team. So back to the baseball analogy, if I'm the best second baseman or one of the best, in the league, but I'm not that same person is not the best catcher or the best pitcher, and you want to build a team. And so a well-rounded team, what I thought we could do is we use our experience as a trader to understand risk management, and we can look over their shoulder and make sure the risk management is right, which is, the older we get, the more you trade, the more you realize that's the most important thing. And so we can do that with them and analyze that and bring some expertise to the mutual fund world. And so anyhow, so the Abraham Fortress Fund, it's FORTX, FORTX or FORKX. There's two share classes, one's 65 basis points, one's 75. And we, in both of them, we charge 50 basis points to basically say, let us make the chocolate cake for you. And it's an interesting product. We think it adds some value. So it's really more of a step to even broader diversification and trying to give the market what they don't totally understand and just do it all for them and say, here it is at a low fee, and we're going to serve it up to you. And I've got a big chunk of my money. I've got a foundation and retirement money, kids trust money. Amongst those three, I've got about $10 million of my own money in it. And this is the way I want to manage what I call my money that I want to be more protective of. And if someone wants to coattail along, they can. So that's it. But trend following, you still can't, you can never get away from trend following. Once you understand the math behind it, like with the trading we do, we're long gold. We usually are long gold all the time at 10%. That's kind of a standard thing because gold helps in wrecks. And but we've been heavier than that for goodness, the last 15 months, about 2/3, 3/4 of the time, we've been heavier than 10 just because we like to trade. So we can increase that a bit. But even today, we have a long Eurodollar trade on and a long Swiss franc trade just because they're good trend trades, but they also diversify us. And we like the diversification of our equities. We said, well, this will help us. If equities keep going down, this will help. So there's certain trend trades that we see that if it can add some diversification and we like to trade, to us, it's almost like it's not a free hedge, but it looks like a free hedge. If you like to trade, you're like, well, I like to trade anyway. and it hedges out my stocks if stocks continue to tank. So there's opportunities we have to look at the non-correlation of trades, and we can kind of look through a list of trend trades, and we said, these would help balance out the stocks, because stocks are always too much. 50% stocks, 70% is way too much stocks. 50% is too much as far as concentration in stocks. But that's the portfolio you're competing against. So you need, if you're competing in a spaghetti contest, you got to bring, noodles and red sauce. You can't show up with a ribeye steak and say, oh, this is way better than your stupid spaghetti. But that won't work. So stocks and bonds is what we're competing against. So if we're competing against 70-30, we're like, let us do it 50-20 and bring in these alternatives that'll diversify us. That the goal is that, and there's no guarantee. In the SEC world, we have to make sure everybody understands that more so even than the CFTC world. So there's no guarantee, never know, but that's the goal. And we're math geeks and we love doing the puzzle. So.
Salem, you're 50, 20, and 30. Is that more to suit investor appetites, or would you scale up that 30 to a higher number if you're yourself?
Yes. So the 30, we scale it up. So it's leveraged up around usually closer to 70. So it's leveraged, and you can the fact that you can leverage it, because you've got 50% in stocks that's a vol of, let's say, 16% annual standard deviation. And then you go, and a lot of these traders are, some of them are as low as 7 to 12, and then you mix them together, and they're not correlated to each other. So in the end, you've got a very low vol, 30%, and you're like, well, this is a great 30%, but we need to leverage it up a bit so it can better offset the overexposure I have to equities. I mean, it's the same as if you traded, say, natural gas and gold. You're not going to trade 10 contracts of both, because natural gas is way spicier than gold. And so you've got to leverage that up some. So yeah, you're right, Rich. 30 is not enough. But you can leverage it. That's the beauty of those.
So Salem, you brought up this idea of the math, and I like the math. I like the math of trend following. I don't like the math of the stocks. Nobody loves stocks more than me. I am the biggest lover. Nobody. I'm in first place. I put myself in first place because half the markets.
You're starting to sound like Trump, Jerry.
First place.
I know.
You can have first place.
Half the markets I trade are stocks.
Uh-huh.
But I want the trend following wrapped around my stocks. I don't want that other math. And you mentioned earlier, I think, before or during the call, that these stocks can go up. They go up a lot. People are telling you, why should I invest in CTAs and trend following or anything, really?
Right.
If the stock's going to keep going up. And yet you know the history of stocks. They don't always go up. And there's long periods of time where the stock market, and it hasn't been 100 years ago either, it's been more recent, where the stock market can go through periods that make our drawdowns and our bad periods look like nothing. So, and I know you don't really, and so I think to some degree we kind of go along, we pay lip service, we have clients who believe in the stock math, the buy and hold math, if it's even math. And so we have to go along, and we have to, forgot your analogy, but we have to eat the spaghetti with them. We have to pretend like we agree with them because they're going to give us money.
Right.
And okay, so I guess there's many things you can say to that, agree or disagree. But I guess at some point in time, like the other day, when all hell was breaking loose, and you know all of this stuff, and you have client money, and they're going to be just fine if you sit there with 50% stocks, and the bonds are not helping you really either. And nothing's really helping you, and like nothing was helping us. And are you sort of like thinking like, I'm getting ready to short some S&P futures, or I'm not going to let this thing just play itself out. If we're in a 2008 scenario, and maybe the CTAs will help next month or 2 months or whatever. What are you thinking as a money manager? You've already let us know that you're willing to do a futures trade, a trend following trade in the currencies. When the going gets tough, what are you willing to do? What were you thinking about doing Or what will you do next few weeks if we start making new lows in the stocks? Is this part of what you've taken on as far as managing this money to actually turn back into being a trend trader to some degree?
Yeah. Yes. So we're the manager of the baseball team. We try to retire from baseball, but every now and then we think and when you try to build a storm-proof house, I think you have to think like an engineer when you're building a portfolio. Not in the finance world, they give us a box of tools, and they're all averages, and averages will kill you. So you got to look at extremes. The most important part of a normal distribution curve is those tails. The tails kill you. The average person on the average day does not die. So you don't need to worry about dying based off the finance guys. So I'm saying, think like an engineer. What's the 100-year flood? What do you do? So what we do is we start off, say, let's build a storm-proof house, more storm-proof than the competition. So that's the 50, 20, and then this 30. Now then, around the edges, you've kind of got to adjust sometimes in the storm. Sometimes you just say, I like my house. I'm in the lazy boy. The wind is blowing, everything. I'm fine. I got a nice, I'm watching TV, let the wind blow. I don't care. So, but sometimes you say, hey, we got a leaky window over here. What can we do? Or what, this thing's going on. And so the things we did in this storm that we've had that are kind of, and it's just fascinating, the things that are different about the storm. So the more times you go through wrecks, you just start finding, hey, these wrecks are really fun. As long as you know, hey, I'm safe. I'm not trading too large. You gotta not trade large and be diversified and have thought it out ahead of time where, if you've got a mostly storm-proof house, you don't have to fear the storm. But you've got to think about what really does that mean to have that storm-proof house. So the things that happened that were unique, 20% fixed income. We always have the thing you want is treasuries. We had 8-year treasuries. Well, those didn't help. So we're losing a little extra money, not a lot, but a little extra money in treasuries. So we sold those and went to 90-day T-bills. And I said, if it's not going to help, there's no reason to have it. I can make 4% T-bills and not have the risk. So, and if that's going to add risk, I'm going to take it in. Well, then gold was at 15%, which was more than our normal 10. So we already had it at 15. And we said, look, people are running to gold. This is like a day or two later. We said, people are running to gold. And so we upped the 15 to 22.5. That's all through futures. So that's beyond what our prospectus says is our normal range. And so we can be at this 22.5 for a little bit, but not very long. And we're not going to be there very long. But I wanted to just get there just in case things really melt down. Everybody's running to gold. So we're there. The other thing we did is we moved of our 50%, 5% of its utilities. That can help in crashes too. And so we got these different things. So utilities are up this year, so we like that. We have, and we had 30% of the 45% left. We had 30% in EFA futures. So non-US stocks in developed countries. So we went, instead of 30%, we added 40%. So we shifted a little bit more of it over to the non-US stocks. So we did those things that are, and then we took, then the other thing, because some of our CTAs or hedge funds, they had extra long stock. I mean, that's what really the bloody nose was. You're counting on them to help you. And so most of the trading, I'm going to let them do it. And I'm going to step back and say, look, y'all are going to do it. And I know number one, you will know how to trade. You'll be nimble. And number two, the big thing I like is they're going to adjust their position sizes as this thing's developed. So I don't have to cut them back. They're going to cut themselves back. But I took stocks because they had extra exposure. I took the 50 all the way down to 40. So and all the way down. It's not much down, 20% off. So we just did a few things around the edge to say, all right, I feel good about where we are. And let's shift some of this out of U.S. stocks over to non-U.S. stocks and increase our gold. And then we added most recently 5% exposure, notional exposure, long Swiss franc, long euro. Because I said, if people run because it's really like the gold trade to me. If they're running from the dollar, they're going to run to gold. They're going to run the euro, the Swiss franc. So I'm like, where are they running to? So if this stock thing gets worse, if the stocks really tank, then that's a bit of a hedge. So occasionally we adjust, and I did that during COVID. January 26th of 2020, I took a third of our stocks off, and I also took my pickup truck I had to drive 100 miles to go to a Lowe's, and I got like 500 Lowe's and Home Depot both, because I was embarrassed. I went in and got all these N95 masks, which I read all about that morning and I loaded my truck up at Sam's with all this food, and I came back and I'm like, this could be really bad. And everybody thought I was crazy till mid-March. So and then I took another third off in February. So there's times that you say, look, like you never want to get out like of stocks and stay out very long. So if you're going to get out, you got to say, okay, I got to get back in and give yourself a limit, because stocks typically are going to be going up. But if you say there might be a real train wreck here, then you're like, okay, you can go and step on the sideline partially. And so I took a third off, and I said, I'm out for 30 days, but I'll be back in, and I'll know in 30 days if this is bad or not. So February 26th, I took another third off. So then the trick is, when do you get back in? Well, then first 10 days of March were Italy and Japan closed schools. And I said, that's it. When Canadian Texas, out in the middle of nowhere, small little public school, when we shut our schools down, that's when I'm going to put my 2/3 back on. And that was March 17th, and the low was like 4 or 5 days later.
That'd be the hardest part, Salem, wouldn't it? Coming back in. It's a bit like putting on a hedge to protect yourself, and then when do I take the hedge off?
Yeah.
That always gets me.
Exactly. Well, and my thought, Rich, was, when is it fully baked in? When is the market fully priced it into the market? And to me, when Canadian Texas shuts down schools, it's like the mania has peaked when it reaches. When a small village in Australia shuts down their school, you go, yeah, okay, that's the top. And so
Salem, you're a bit like Ed Sakota in always apply the rules, but know when not to.
Yeah, no, there is a point. So there's a funny story about I'm absolutely, the math of trend following is so convincing, but sometimes you see where it can't get worse than this. And I always think of it like, if I'm in the back of a boat and there's 100 people in front of me, and there's 500-pound people and 50-pound people, these 100 people, so some are bigger than others. But if they're all on the right side of the boat, I'm like, it can't go any more right, or left side of the, like, things are not, they can't get better than this, or they can't get worse than this. This is the worst they're going to be. So I always have that in my mind. Well, I heard on the radio, this is like 15, 20 years ago, and they said, oh, there was a tourist boat down in Austin, and they were going by, and it's like, well, folks, on the left are these houses that are really pretty and nice, but on the right, there's Hippie Hollow, which is a nudist colony. Well, you can guess which side of the boat. For whatever reason, we all have got to think, well, let's look at the naked people over here. So anyhow, that's human nature, I guess. So what happens then, I'm like, oh, well, that's the most it leans over. Well, the boat capsizes. So that's the news story. The boat capsizes. Well, and the nudist colony, we imagine they're supermodels, but they're really very unattractive naked people. They're not supermodels. Well, so the boat capsizes. Well, who comes to rescue the poor tourist? It's the unattractive.
Oh no!
They're dragging them to shore and helping them to get. So now you go, okay. So that reminds me of being with the crowd. I tell people, never be with the crowd. Like, the crowd is, I've never made money with the crowd. And if the crowd's all on one side, you're like, okay, it can't get worse, but it can get worse. You can be rescued by unattractive naked people. And they take all your money.
Yeah, I told you. He's funny, he's smart, and he's funny. So there you go. It's a great combination. Yeah. So anyhow, but we love doing the Fortress Fund. It's a fun group of folks. It's a scaled down version of our group, and we've had all these interesting experiences, but it's a small fund right now. We've only got 75 million. It's hard to raise money in the mutual fund world, but as we continue to do well, and people see us through different times, that helps us. But this latest train wreck, we haven't done better than average. We've done more average, which we don't like. So we did great through COVID. We did great through 2022. These trend followers helped us and did terrific. But so normally we want to really shine in the storms, but this latest storm we haven't shine at all. We've gotten punched in the nose like everybody else, like trend followers have. But the one thing I know, our team and trend followers, this team is built for the storms.
And you think of when we've made money. We make money in storms. And I think this storm is not over. I think it could be a long, drawn-out storm. If I were to draw a parallel, I think it might be more like this dot-com meltdown from 2000 to 02. It may be a 2-3 year just kind of quandary that we get ourselves into, because the one thing that's going to be tricky for Trump is to convince people it's okay, come back in. I know I've been beating up things, but if your dog comes to eat, has been eating there 5 years, and one day poor Fido, you hit him with a 2x4, he's going to say, I'm not coming around the food bowl when Rich is there because he hit me with that 2x4. Like, well, when someone else feeds me, but not that rich guy. So anyhow, so that's where I just think Trump may. The Great Depression was caused by a loss of confidence in the markets and in the government and the regulations and the banks, and that's where Trump needs to be careful that he doesn't so totally hurt confidence in him as the bus driver. If the bus driver keeps scaring the people in the back of the bus, and it could. So I like our team. That's the punch. I like Trent. I know it's gotten off to a bad start here in April, but it's a fascinating market. It's interesting if we follow it. And I think, like Jerry said, you just follow it. And where's it? That's what we're going to do. We're going to follow it, and it's going to show a path, and you get on it. And I think there could be long, extended trends that could really make money. And the group and the team we've put together, if I had to bet on any one of our three pillars of diversification, the stocks, the fixed income, or the traders, I'm with the traders. Absolutely. When there's a storm, you want to be with a nimble group of traders that are going to follow and not try to guess. They just say, well, where's it? What's moving? Just like gold. That's fascinating.
Well, it's interesting here. I'm looking at the volatility of the fund since inception, and it's favorable to the 70-30 or the all equity portfolio or volatilities.
Yeah.
I mean, the Fortress Fund, it appears to have a vol that's half of the MSCI stock index.
Yeah. No, and that's the idea of it. Now, it's funny, the 3-year and 5-year numbers, like on Morningstar, they just cut off March. So they cut off 5 years ago was March of COVID. So they cut that out, which we really shined in. And then they cut off 3 years ago was 2022, which we really were shining in 2022. So they cut off. So our 3 and 5 year numbers suddenly looked like, we're lagging the 3 year, 5 year for 70-30. But if you look at the full track record of 70-30 and us, it's like, okay, don't take away our best months. But they did.
You're a victim of arbitrary time frames.
Yeah. No,
so would you say, Salem, would you say that the volatility is reduced by the trend following piece that's systematic, or is it the discretionary element in the with the traders? What's the weighting there?
I think a little bit of both. The fact that, the vol is going to be less because we've got less stocks than 70. So 50 is going to reduce vol. Introducing non-correlated returns with the 8 hedge funds, that's going to reduce vol. And some of our trading will, as we pick it, can help reduce vol too. Like long gold has reduced vol here lately. Now gold has really picked up vol here lately. So it's and our position's a large position, but yeah, no, we can't guarantee we hit our target vol is 9, and we're a little lower than that, and you can't guarantee you hit the target, but typically 70-30 is around 12. So the goal is if we can be 75% the vol of the 70-30, but hit the same return net of our fees, and about, if you look at a chart with us in 70-30, about 40-50% of the time we're above 70-30. A little less than half, but when stocks really take off, we get left behind.
And so it's interesting there. You're saying you're targeting 9 or forecasting 9, because there is a subtle difference in terms of the bogeyman of vol control.
Yeah, we're I'd say more forecasting. We're aiming, and sort of targeting, but we don't adjust. We're forecasting 9. We're trying to model it for 9, but. And so why 9? Sort of leading on to market volatility and optimal
optimal vol for a portfolio or a strategy? Why 9?
So, like, we will not adjust the vol. Like the hedge funds, we give them an allocation and they trade it. And so what we're trying to do is, over the long term, average 9, because we think 9 it's less scary than the 12 that's 70-30. So many people out there are at 70-30 with a 12 vol, and they think that's a balanced portfolio. But instead of 2 pillars of diversification, we add a third pillar and say, let us show you this area of liquid alternatives or CTAs, managed futures, whatever you want to call it. But let us show you a different return stream that's not correlated, but if it can make us 8% and we can tweak it with the vol, if we can, and then all of a sudden you're like, okay, here's a different return stream. And so, if you've had a 60% coin, one of them, and then you had 2 or you have 3, you say, which is going to have the best Sharpe ratio? The 3. If you split your money in 3 pieces instead of, if you could bet 100 on one coin, 50 and 50 on 2 coins, or 33 on 3 coins, the 33 on 3 coins will have a better Sharpe ratio. And that's all we're doing. It's Harry Markowitz, who won the Nobel Prize in modern portfolio theory. The math of diversification is fascinating, but most people don't really take the time to think about it and understand it. And then the value of non-correlation that comes with trend following and other managed future strategies too.
Yeah.
But, trend following is the one thing that, whether it's, 2 minutes, 2 days, 2 weeks, 2 months, 2 years, you find trends, and depending on your time frame, and the markets do trend. And if you just got to pick what time frame makes the most sense for you. And
yeah, absolutely. I mean, diversification really is the only free lunch. So that's, you can do diversification within a trend following strategy, but then blending trend with stocks and bonds, can push out that efficient frontier. So we do a report on our website called The State of Trend, and we quarterly redo that curve, and we blend our product with 60-40 or 100% stocks. Right. And we refresh that curve every quarter. And, we advocate, we're 100% trend effectively at East Coast Capital Management, but there is
we would never dally with buy and hold, Salem. Never.
Right.
We understand that clients are coming usually with a legacy portfolio. So for them, they're going to be making an allocation, from somewhere less than 100% to trend, and it's important to understand how does trend or CTA interact with an existing 60-40 or 30-70 or 100% stock, whatever you've got coming in, because potentially you're actually going to get an uplift. You're going to get more return for less risk,
right?
By blending those two things together.
Right, and what we're trying to do is, we're really focusing on the retirement money market, the 401k money, the IRA money, and then foundations and endowments, because the mutual fund is not as tax efficient, but what it is it's a one-stop shop where you can buy a fully balanced and portfolio. We think more balanced and more diversified, and if you're living out of it, if you're taking money like a retirement, if you take 5%, whether a foundation or a retirement, the volatility is going to tax it, and so there's that volatility. The added volatility is harmful to your money more so than less volatile. But it's a big deal when you're pulling money out. So what we tried to do is just say, let's give them a one-stop shop. Here it is. It's you can get in and get out daily, and let us come to the kitchen understanding that math, because we've come from 31 years of managing, the managed future CTA space, and we did it successfully. And 31 years, we had 13.1% net to clients over that period. Now, it was all in the front end, 21 years. The last 10 was flat. And so that's interesting. And then what Jerry said earlier that was interesting too is, with interest rates going up off zero, I think a lot of that bad 10 years in the trend following had to do with interest rates were zero across the board. That means currencies aren't going to move because you don't have people chasing returns. So it hurt those markets for about 10 years, and it's great to have interest rates off zero, and it's great to have countries really kind of arguing with one another, which then now we've got market movement that's really interesting. And so, so we're trying to give Adam a one-stop shop, and have someone that our skill set that's unique is we understand the space. We're watching over these traders. We think we can recognize if they're doing something reckless, and we can get out of them before they have the wreck, So.
Well, it looks very interesting, and congratulations on your fund and the performance and vol to date.
You bet. Thank you.
All right, gentlemen. So, look, in the interest of time, because we know that Jerry's got to leave shortly, we might move on now to Mythbusters. So, Jerry, this is where you sort of suggest a few topics to break a myth or two. And what is the topic you want to discuss today under this segment?
Well, I think it's apropos to talk about crisis alpha and how we didn't have any crisis alpha with CTAs and trend following. And I'm not a fan of crisis alpha. I kind of like it, but in some ways I don't like it. Of course, trend following adds value to a portfolio. It's going to be a diversifier. It's pretty simply because it doesn't trade all stocks and all bonds, and it goes short. And the currencies and the commodities are helpful and can have trends when stocks are doing poorly. And having a trailing stop and a stop loss on the stocks is good during a bad period, and going short stocks is good. So, of course, trend follower can help. But I just think that managed futurists has maybe overstated the case for crisis alpha, which is maybe random. It can help.
Well, that would be assuming we were negatively correlated to stocks, but we're uncorrelated to stocks. So there is no guarantee of crisis alpha in certain instances.
And, I was just thinking about it in 2008. This is the last time that I think CTAs really got ahead of the sell-off and did pretty well. The S&P hit a 200-day low in January. So it was kind of chopping around, and it was kind of close to the all-time highs. And so you had this perfect setup, and that worked really well. But ever since then, we've had these V-bottoms, and which CTAs have hurt performance usually. And the trend following of stocks and stock indices especially has been pretty poor. And then I think another thing that CTAs they're too involved and too interested in being that crisis alpha. The industry sort of sells itself as crisis alpha. The temptation would be to trade suboptimal systems, suboptimal time frames, to hurry up and get short so you can be more crisis alpha. And we know that the longer term systems are better overall, performance-wise, for us, for our clients, for the people who buy trend following. But shorter-term systems, which are not great, would be better for convexity with the stock market and more crisis alpha. So I think that we don't want the CTAs to be incentivized or kind of compromise what they're providing. We should be providing clients and the best trend following we can provide for people, and not playing this game of crisis alpha. And we should be creating the perfect portfolio ourselves. We have the tools, we have all the markets, rather than trying to fit in with, with portfolios, which I think is a good idea to fit in, but it hasn't really worked out for CTAs because the assets for the industry hasn't really grown very much. And so this sort of kowtowing to here's what happens when you add 5 or 10% to a portfolio has really not worked out for the CTAs so much. And those numbers are fairly low. They're not going to really move the dial so much. CTAs deserve to be a material part of the portfolio, regardless of crisis alpha. And I think just focusing on this too much and having this reputation when you can't deliver, it leads to improper expectations, over-promising. And now we have papers coming out, and Salem hinted at this, and it's obviously true. Don't dispute the papers we've read or what Salem said. Now we're sort of told, well, I'm sure we've been told before, but now it's coming out. I can just imagine being a client and these new papers are coming out and saying, whoa. CTAs are not meant, or they historically have not helped with the first 10% of the drawdown, but be confident that the next 10% that you have will be right there for you.
Yeah, not necessarily the case.
Maybe not. So, anyways, the overstatement of and kind of I love Katie, and I think her book with Alex. I'm friends with both of those guys, and they're great. And I think this whole idea that, hey, crisis alpha can be a thing. It can be a thing. It doesn't have to be a thing. And if it's going to be a thing, I don't think it's a good idea for CTAs to self-harm themselves with suboptimal ideas and portfolios and systems to sort of maximize what they can do. CTAs deserve to be standalone and invested from 0 to 100% of your assets. And of course, they're going to make a portfolio better. But I don't think we should talk too much about targeted crisis alpha. What do you think, Sam?
We're trying to be more sort of, appealing to all types of investors, when in reality, we're trend followers. We're not long vol. We're not, Nassim Taleb's fund, or, those people that deploy options for immediate effect, which are negatively sort of correlated with the equity. So we are trend followers, and we are uncorrelated, which doesn't guarantee anything. It just says that we have uncorrelated properties, and it helps for diversification benefits. So rather than being all things to everyone, we should be really clear in what we do, rather than trying to be all things to everyone.
So, Rich, where is that? Somewhere there's a group of marketing majors. They're not finance majors, but they go, we got to come up with a cool phrase. And they come up with all these cool phrases like, crisis alpha. It's like, who comes up with that? Like, is there alpha? Like, alpha ought to be like everyday alpha, like any day, every day, any day, but not every, or someday alpha, but someday not so much. Anyhow, it's like risk parity, which Ray Dalio made famous. And I'm like, we just call it equalizing risk out here in the country, but risk parity is way cooler. Anyhow, and they say this is marketing this, crisis alpha, because they saw that a lot of times it works, but it's like, well, it's a fresh coin flip, but it's not a guaranteed coin flip. And so, you saw that during COVID. They didn't, it didn't, a lot of the managed futures didn't work well during COVID. And so, you say, well, sometimes it works, sometimes it doesn't. But that's why they don't let me market. Maybe. But it's a fresh coin flip, like you're saying, Rich, and it could be tails too. I flip a coin and it's tails, and by golly, you flip one, it's tails too. But they didn't have anything to do with each other. But they. So now,
in fact, actually, it can actually even be worse, and because you could go into the month long equities, and you will lose on that trade, and you might end up short equities halfway through the month, and then you might get a V recovery.
Right.
Intra-month, and the market might close well off the lows, and you're sporting losses from being long and then short.
Right.
So it's all going to depend on the timing and the channels, and and your moving averages or whatever methodology you're using. But I would just caution people just to not use 1 month as a measure of correlation, right? So if you're doing monthly reporting, you need a series of months to create a correlation, just mathematically.
Yes.
And really you want to look at this over quarters, 6 months, 12 months, and then put that in context of, how do those markets work over a decade, or 3 years, 5 years, whatever it is. But 1 month is not a correlation.
The only problem with that is that, even using the history as a basis to guide you into the future, to me, I can imagine scenarios, even with protracted crises over years. I can imagine scenarios where we might go down 10%, then a massive whipsaw event occurs, then it will go down another 7%, another massive whipsaw occurs. I can imagine scenarios where trend following is going to be hit all the time during that particular protracted scenario, which, even in instances where we say we might not get the first 10% because our ships take a long term to time to turn around, there is no guarantee, even in a protracted crisis, that trend following is going to be a saviour. I think we've got to recognise what trend following does and what it is, and recognise that there will be unfavourable environments in a lot of these scenarios, which unfortunately, at least we've got models which are robust. They've suggested that they're not overfit. They can respond to a variety of different regimes. However, there's no silver bullet. I think we'll get onto that anyway. We'll miss the opportunity this time where we were going to go into risk of ruin, Adam, but unfortunately we weren't able to talk about it.
We can pick that up another time.
So, gents, we've done Mythbusters. So now it's time to move on to our segment called Shell Mail. So everybody, I'm going to mention a few questions that have been asked by our listeners, and I'd love to get your thoughts as we go along, Salem, you included, as we go along. So the first question comes from Jason in Canada, and Jason asks, how would you define a strong, robust trading system from your point of view, and what are the essential elements of it? So let's start, Jerry, to you first.
I hate to answer questions like this because, the reason is because I give the same answer every single time. For 40 years, I have the same answer, and I haven't really evolved or learned very much. But I think for me, it's fairly straightforward, and that is one entry, one exit, and a stop loss. So a system with very few parameters and rules that produces a large sample size. And that's how robust it's going to be. I think it's possible to have a system that doesn't make money, but it's really robust because it all revolves around that. And how reliable is this? And the reliability is purely going to be based upon how fitted it is and how many rules you have and how many trades you can count. Certainly, I'm a big fan of diversification as well. I have, our main fund trades 400 markets. So I think with those two things, that's how you're going to figure out if it's robust. Not a Sharpe ratio, not volatility, but what sort of rules are you following, and how fitted and overfitted is your system?
And gents, anything you want to add to that?
Jerry's right.
Of course he is.
He's the master. That's why he's the master.
Well, one of the things I think I wanted to comment on something you said earlier, and that is I hadn't learned very much since 1984. So, I learned a lot through experience. I learned a lot of things that I shouldn't be doing, but I kind of already knew I shouldn't be doing them. But I'm just pretty much copying what I learned from Richard Dennis and Bill Eckhart. And I think that's the key to success for the Turtles. I think you're successful to the degree you want it to be, and to the degree that you basically follow the rules. And the answer to most of Rich's questions was sample size. So, yeah.
If I'm thinking of what the word robust means, it means to me that I can be in any nasty condition or any volatile condition, but provided I never let my losses go to the left tail, so long as I always cut them short, diversification, small bets, cut losses short, that's your robustness, because the upside or the opportunity is something that naturally occurs. You want that, so you don't you don't tamper with that side of the equation. What you're trying to do for robustness is say that nothing is going to catch me with a left tail event. I think that's how I see it.
Yeah, so cutting your losses short is probably one of the most important elements of that system.
Yeah, so Jerry's rules, small bets, cut losses short, let profits run. That's robustness. And not loose pants and massive sample size. All right, so next up we've got Marcelo Zamboni from Brazil, and Marcelo asks, do you utilize any limits on concentration in your portfolios when multiple signals point toward the same trade? for instance, long USD against multiple currencies? And how often, the second question, how often do you rebalance positions to maintain risk levels, daily, monthly? And also, do you believe in pyramiding positions or not? So
there's a bit in there.
There's a three-part question here. Firstly, let's start on the first one. Do you utilize any limits on concentration in your portfolios when multiple signals point towards the same trade?
I limit my concentration before multiple signals point to the same trade. So I'm ready for multiple signals. I'm ready to be 100% long the dollar or short the bonds in every market. All the interest rates I'm short, or all the currencies I'm short. From the get-go, I'm not waiting. I'm not getting my act together, my risk control correct. When this multiple signal thing happens, I'm always ready. If I have a lot of diversification in the currencies and the interest rates, for instance, great, I can handle it, of course. If I have no diversification, which we've had a lot over the past few years, we were 100% short the bonds once, 100% short the currencies once, then I have the proper balance in the proper concentration in my portfolio. And that's what traders need to do. Don't get it wrong and say, you know what, I'll scramble and come up with a new rule. I'll get it right when things look dicey.
You're saying you have the rule in there already.
It's in there already. My concentration assumes the worst case scenario.
Right.
I'm in the same bucket with Jerry. And I would not advocate if you get 10 correlated positions, I don't think that you should then be scaling down the risk after you put on the 10, because you're effectively diluting what could be a fantastic outcome.
You mean reverting? That's right.
Or skip a trade. Skipping trades. Like if we sit in front of the computer, like I used to do, I used to sit in front of the quote machine. And sometimes when I was young, I just didn't want to do the next trade because I was afraid. I didn't want to lose money. Everyone in the world will tell you that's incorrect. You got to be disciplined and consistent. Well, now I have a rule that says, hey, skip this trade. Well, the computer doesn't, the math gods, they don't know that why you're skipping the trade. They're like, dude, you're skipping a trade. You skipped it in 1985. You're skipping it today. It doesn't matter what the reason is. This could be a big trend and you're going to miss it. And that's the reason you don't ever skip a trade. Well,
any big regrets, Jerry? Have you skipped the trade and then?
Of course I have. Thankfully I was punished every single time I did that. So then I learned not to do that.
I think there's an assumption by many people that opportunities exist all the time in these markets, and that's not the case. Opportunities arise at unpredictable times, and you can't afford not to concentrate on that opportunity. In fact, you've got to exploit, or you've got to concentrate on that opportunity, because we don't get this wide distribution of opportunities across the market at all times. They're clustered. They occur in regimes or at different areas. So in light of how a trend follower like us sort of exploits opportunity, we might apply a small bet to a trade, but that might explode into a huge component of the portfolio, like the cocoa trade. And, that might have been representing 25% of the unrealized profit of our entire portfolio. From that single seed, that would be called massively concentrated risk. But there are those that believe that they would taper that level of concentration because obviously they're assuming that opportunities are everywhere at all times to redeploy what's been taken off from that trade elsewhere. But I don't think that's the case with the way these outliers and these massive opportunities arise. They're not spread everywhere, diffusely operating across the entire market. They're clustered, and you've got to take that opportunity, exploit it when it's there.
Cocoa is the example for almost every good trading lesson. And so if you don't have cocoa in your portfolio, it doesn't matter the excuse. You just blew it. You didn't have that big trend. And I know people who didn't have cocoa. If it's one market that you want to trade, you should always take that trade. And that's the secret of trend following, is to take all the trades. Doesn't matter your reasoning.
Let's move on to the second part. How often do you rebalance positions? I'd like to say outright that if you think of what we do with our models, we are actually rebalancing every single trade. So what I'm meaning there is that we define an amount of risk we're prepared to take for each bet, and based on our realized capital at that particular point in time, that's a standard amount for any trade we take at that point in time. So rather than we are always rebalancing every time we take a trade. Is that how you guys see it?
Yes.
Well, to make a distinction, I think we're sizing the position as it comes, but at least I'm not rebalancing existing trades when a new trade comes in.
Right. I think that's what the question means is it's the traditional way of looking at rebalancing. You made a lot of money in cocoa, or you may, how are you going to rebalance these positions? And I'm like never rebalancing. I mean, I'm going to change my trade level every now and then, infrequently. Hopefully, maybe once a year, I'll capture that year's profits if there are any, and increase my trade level. I want to keep the trade level kind of absent of open trade profit, and I also want to. Step two is to not change the trade level too often. I'd like to go a long period of time if possible. It won't be possible if I'm too successful. If I'm making way too much money, I'm like, I got to increase the trade level quicker than I want to. But I like to do a year's worth of trades, the same size. Everything's the same entry, same exit, same stop loss, same size, same equity level that I'm basing the position on. So sometimes if you're too successful, though, you can't do it. But unfortunately, my trade level has been very consistent over the past few years.
But also, Jerry, that's because you're not predicting as well. Like, you don't know where the next outlier is going to be. So you've got to equally weight all of your bets in a maximally diversified stance, because you just don't know where that's going to occur, where that next outlier is going to be.
But I think doing it this way also speaks to the risk management. And part of the thing that we the three of us, I think, agree on is pretty much not including the open trade equity in, as part of the equation to calculate your size for each trade. So this is a very, very big thing as far as keeping the risk under control.
All right, let's move on to the next question. So this next question is from Daniel Watson. He's got a couple of excellent questions bundled together again. So he asks about the pros and cons of combining seasonality with trend signals. That's the first question. Second question, how to manage system-wide risk during black swans without missing big trends. And the third question, do trend followers look at basis spreads or term structures such as backwardation? And is there any role for fundamental data in trend following? So let's isolate that. So firstly, is there a role for fundamental data in trend following? What would you gentlemen say?
Not the way I do it.
Yeah.
Fade the fundamentals.
The fundamentals.
Fade the fundamentals, yeah.
Exactly. I suppose the assumption is that we're using price as the definitive measure. In fact, we're using this price basically has everything embedded into it. We're using the now, what the price is right at this point in time, to react to that price. We're not predicting it into the future, we're reacting to it. And it's a bit like I had a conversation on X the other day, having a bit of a battle with people talking about forecasting. And I said, we don't forecast. And if you consider the world's best tennis players, like Djokovic and people like that, they're not there thinking about the forecast or their expectancy over the next 10 hits. What they're doing is that they're focusing on the ball, they're getting their risk at the right angle, they're exploiting opportunities against their opponent at any time. They are participating in the now, looking for opportunities and reacting to those opportunities. That's how I see a trend follower. I don't see us as someone who takes significant stock in what is our expectation, because we don't know what the trends are going to be in the future. But I do know that we react to price, and prices is the only fundamental we look at. What is the actual price? I don't know how you gentlemen feel about that.
Yes, we're with you on that one, Richard.
All right, so that's the fundamentals. The next one, do we combine seasonality with trend signals?
Wow. The questioner didn't get the memo about price only.
Yeah.
It's all
Okay.
It's in the price again.
Yeah.
That's what I'm thinking. Okay, how about this one? I do know a few do this. So do trend followers look at basis spreads or term structures such as backwardation?
I think it's part of the return, so if you're getting a favorable roll, you might juice up your long return, or if it's in a steep contango, you might get a positive roll from the short, rolling the short. But I haven't necessarily put a trade on because of the level of backwardation or contango. But I think it makes a difference to the price, to the outcome. What do you think, Salem?
Yes. No, I think, it can be in there. But I if you had a multi-strat system, you might have something that is quantitative and could look at those as some kind of trading system. But for trend, and like what we do, even with fundamentals, there's times in our mutual fund, I look at fundamentals and I do things to adjust positions just because I'm mainly managing the risk and the risk exposure. But if I'm doing trend, I do trend, and I do that. And, if you're riding a bike, you ride the bike. You don't think about running. You don't think about lifting weights or whatever. You're riding your bike. You focus on that and you do that well. And if you want to have a different system that does something different, like seasonalities or any of this other stuff, fine, but make it separate. You don't want to, you start mixing those and you end up muddying the water a little too much, and you risk having too many degrees of freedom. And that's the real risk, is you start, if you said, well, what if seasonalities are, let's decide which day of the week when I put a trade on. Of all the trades over the last 20 years in my simulation, there's going to be, you could either be Monday, Tuesday, Wednesday, Thursday, Friday, right? So you say, well, which is the worst day? And you go, okay, well, Thursdays, just randomly, there's going to be a worst day, there's going to be a best day, and the three in between. So you can say, well, let me just eliminate those Thursday trades. Well, you've introduced a lever that you say, I'm going to eliminate 20% of my trades because those are the worst days. Well, your system got better, but it's just a bogus lie. You're like, no. So I introduced seasonality in the days of the week. How about that? And you go, okay. Well, and so you risk adding and Bill Eckhart in the New Market Wizards book, he talks about degrees of freedom. And that's a good one to look at, where you need to have it robust, not many rules, and you don't want to clutter it with other things. So that's where I think you see us it's not that those things are wrong and don't work. It's just make sure you don't try to, mix the two together. Just say, no, here we are, we're doing trend following. Let's just do that. And let's do the other thing over in a different bucket and a different trading program.
There are liquidity issues and transaction costs as well, so if you're filtering for the day of the week, or if you're doing a seasonal spread, it might look good in the data, but then, there's no volume in the outer month, in the far month, because you were spreading 25 to 26 or whatever you're spreading. So sometimes the data might lie a little and you can't really get set the way you want to, and then you're probably going to have to use a bit more leverage in those spreads to make it meaningful.
Yeah, and that is where your time period with trading, that's where you see the largest trend followers. They trade longer because they can't put on the size quickly enough. You can't be trading, some, let's say $20 billion and be a 2-day trade. And because you can't get enough of a position on, and unless you're doing it all in, say, maybe crude oil or treasuries or S&P 500, you get a huge market, you can do it. But if you're going to trade cocoa, it's not going to happen.
And that's where all the trading actually gravitates to the liquid front month, and you're going to want to be in, the first or second contract, which means you're not necessarily going to be able to take advantage of those seasonalities. But let's say there was a crop and it was picked in July every year. Maybe you'd have a chart that just rolled July, July, and maybe you could put those up. And I know one of our colleagues, I think he mentioned that he was doing something, where they weren't necessarily trading the front month in crude. Maybe it was a couple of months out, and that helped when there was contango. You weren't getting hit as hard on the contango, but to the same, it's a double-edged sword, because when the market went into backwardation, he may not have been picking up all of the backwardation that was, you had $1 roll every month, and maybe you did that 6 or 7 times, and that became material. So, it can go both ways.
All right, gentlemen. Well, I think that wraps up the questions. So, look, I know Jerry had to leave us, unfortunately. Time ran out. But, look, we might wrap up the show now. But for all the listeners out there who want to send in their questions, send them through to aussieturtles.com. You just go to the website and go to the comments section.
Did you get the audio link? You can record a message and send it.
Yes, so there's an audio link that's working now. So if you want to record your audio, we can get your voice onto the podcast next month. So next month, we're going to have Maritz Siebert joining us, which will be great. Another classic trend follower. Salem, I've got to thank you very much for joining us on this podcast. You're a blast, and we had a great time.
You bet. No, it's great to be with you and Adam, Rich, and with Jerry. It's always a lot of fun to talk trading with folks that are interested and study trend following, and so it's a great way to make money, and it's an interesting math puzzle, and it's great to be with you all. Thank you, and it is fun. Texas and the Aussies, we're not that different. We're on the other side of the planet, but we like things outdoors and and out and away from people, and you can think better. So I think you're out. That's where. With me being out here, people say, well, you need to be where the all the information flow is. Like, no, all I need is the numbers in a quiet place. And then
I'm up in Queensland, Salem, and Adam's down in New South Wales. So we tend to think up in Queensland. We've got the big things up here, a bit like Texas. Everything's big up here.
Good. Well, So things are big in Texas too. So we know. Yeah, that's the way we're wired. So anyhow, so it's fun to hang out and spend time with. We've got things in common outside of trading too. So. Even though we're on the other side of the planet, but we all have a great rest of the day, and it's great to hang out. Okay.
Many thanks.
Thanks for coming on, Salem.
All right, you bet.
Okay, Adam, cheerio, mate. See you next month.
May the trend be with you.
Thanks for tuning into Turtle Talk. If you enjoyed the episode, don't forget to rate and review the podcast. It really helps us reach more listeners. Share it with your friends and invite them to join the conversation. Got a question for us? Send it to info@aussieturtles.com, and we'll do our best to feature it on a future episode. Please note, Turtle Talk is for informational and educational purposes only. The views expressed by the hosts and guests are their own, and do not necessarily reflect the opinions of the podcast producers or affiliates. This podcast does not provide financial, investment, or professional advice. Always consult with a qualified professional before making investment decisions. That's it for today, folks. See you next time, and as always, may the trend be with you.